right, I think we are all set. We're ready to go. Welcome to the second last session of the conference. We're talking about selecting your lender, making sure you've got the right lender in your on your team. I'll introduce myself real quick. My name is Nathan Turner. I live in Canada. I do all my business in the U.S. I buy notes. So I'm here to see if I want to buy any DSCR loans, and that's kind of expand my portfolio. Let's go down the line here, and everyone can introduce themselves and tell us a little bit about what you do and why you're here.
Sure. My name is Anil Sharma. I work at Acro Lending. I'm a director. I help run the correspondent division, also the RTL side too as well.
I don't think that mic is on. Hang on.
No, it's not.
Can we get that mic? There you go.
Good morning. So yeah, my name is Neil Sharma, director over at Acro Lending. I help run the correspondent division, also the RTL side too as well. And I'm basically here just to hang out and speak with everybody here.
Hi, my name is Lisa. Is this on?
Is that on too?
My name is Lisa Shriver. I am the SVP of correspondent lending for eResi Mortgage. We're a whole loan buyer. So in relation to this particular conference, we would buy DSCR loans as well as we buy all non-QM loans from lenders across the country.
My name's Liz Lopez. I'm a loan officer with Nexum Mortgage. I'm also a real estate investor. I've been in the mortgage business for 20 years. I am a high producer at Nexa. I came in number 9 in units last year out of 2,800 loan officers, and I specialize in the DSCR loan product. 95% of my closed loans are DSCR.
And my name is Avalon McLeod. I'm the head cook and bottle washer for McLeod Capital Fund. It's a private lender in South Florida. I also have a mortgage brokerage, McLeod Capital Lending. I did 20-something million last year, and this year is going to be my best year yet. We already have 58 million in the pipeline.
Fantastic. Great. So we are talking about selecting your lenders here. So let's start with the idea of selecting a lender. Why would you want to have more than one lender available to you? What's the advantage to that?
Sure. Yeah, so look, I mean, Acro obviously should be your first choice, and eResi should be your second choice. But no, all kidding aside, absolutely, because the market is extremely volatile. Just seeing where pools have come out, pricing is just all over the place. The 2-year and the 10-year have been moving extremely, just ferociously all over. So yeah, having two lenders, because like rates, there's times, I guess, like last week when you can tell like where they moved multiple times in one day. So, and certain lenders are not as sensitive as others. So I think that should, that should basically be the reason as to why you should be working with two. Obviously, look, all kidding aside, the largest two, groups out there are Veris and Annaly, and then we're obviously, I think, slightly there right after them. So yeah, besides them, I think you should, do your due diligence research. I would recommend to work with 4 or 5 personally, if it was me, if I was a mortgage banker. So yeah.
Yeah, and I would say eResi is growing. We actually locked $9 billion last year and funded $6 billion, so growing very rapidly, right on the heels of some of the larger buyers. But I think really one of the things that's really important, price obviously is important, and I'm sure Liz will talk about that. She was locking a loan when we were getting ready. But also it's really understanding that you have outlets, right? So for every channel I've ever built, and I've been in the business over 30 years, I primarily have built channels of business, for people like, I was part of the group that started the Sprout Mortgage entity. I've also worked for New Res, New Penn, many large entities. But I've also been a correspondent lender and started a correspondent lender once or twice. And whenever we were putting out a program or a product, we always ensured that we had at least 2 outlets. And the reason for that is not just price, for sure, but it's also underwriting, right? Like you've got a deal, and if you have one outlet and that outlet does not buy that loan for whatever reason, there's a nuance to it that you didn't understand. It's extremely important to understand who your investors are, what products they offer, what are their nuances, what are their niches, but also ensure that you have a minimum of 2 outlets for each loan that you produce. You don't want to be caught without having, you're just stuck with a loan and then you're just begging somebody to help you. So that's a very important key, especially on the non-QM side, because there are so many soft guidelines that you might not understand. The matrix items are easy. I think we're all fairly similar on the matrix items, but it's the soft guidelines in the non-QM and the DSCR space that is very important for you to understand.
As for a borrower, I think they should want to go to a broker because we have so many lenders that we can go to. As probably you're all familiar with every DSCR lender has a different set of loan guidelines. I've got a spreadsheet. My background's in underwriting. I was a conventional and FHA VA underwriter for 12 years. So I have a spreadsheet with over 100 DSCR lenders on it, all different tabs. What's the minimum credit score, minimum loan amount, cash out refi seasoning, because all these lenders have a different set of guidelines. So I think it's very important to have a large spectrum of lenders that you can go to for these loans.
Yeah. So if you're working with a lender, you have to choose a lender that's very flexible and very creative. Unfortunately, it's really hard to find that in this business. That is where a broker comes into play, right? Because you want to make sure that even if you're getting into a bridge loan, you want to make sure that you have access to a lender that will be able to take you out of that bridge loan. There are a lot of lenders, because if you really think about it, RTL loans are DSCR loans too. They're really like short-term DSCR loans. So even when we're underwriting the RTL loans, we're looking at the takeout aspect as well. So you want to make sure that that lender that you're working with can take you out as well. A lot of times we even turn down bridge loans because we just don't see how they're going to exit with a DSCR loan. The next thing is you want to make sure that you have access to a lender that has, different options. Like in this market, we have second position DSCR loans. You can get a DSCR loan behind the first mortgage. You want to make sure that you have a lender that can do that as well. You know what I'm saying?
So a follow-up to all that is, so in my world, relationships are absolutely paramount. So I imagine it's the same kind of thing in DSCR lending, where sometimes maybe the deal isn't quite right, but the relationship helps the deal. Is that correct? And I don't know who wants to answer that one.
Relationship with the lender?
Between the lender and the borrower, yeah.
I mean, definitely. As you probably all know, it's sometimes it's really hard to get these loans done. Some of these lenders, it's like pulling teeth trying to get them to, sign off on these conditions. And if you have a relationship with your account executive and especially the inside team, I think you can get a lot done that way. I mean, I've had to go to the CEOs of these companies sometimes because I'm having issues with their inside staff, and have them jump in and help me out. So definitely, building that relationship is very important.
Yeah, and I would say from an exception perspective, right, there's lots of exceptions in this space. So the exception piece comes into play when you do have that relationship. They really understand where you're coming from. Like, if I were working with Liz, I'm like, this woman probably knows a lot more about it than I do even, or you really have the experience, right? So if you've got a good relationship with your lending partner or whomever it is that you're using to fund your loan or buy your loan, the more you understand each other and the more you have respect for each other, you actually can get a lot more done.
Yes. I would say that overlays aren't written in stone. So there are a lot of lenders that will close the deal because they know you personally, and it is very important because I have one lender that I work with, because as you guys know, I broker the DSCR loans. I have one lender that I work with. He makes my job so easy to the point where I feel like he's working for me, which he really is. And if there's anything that we have to override, any exceptions, he will do it, and he will go above and beyond. He's not trying to kill the deal.
Right.
He's trying to figure out ways to make the deal happen with me. So yes, I would say relationships is very important with the lender, of course, with the borrower as well, because the better the relationship is with the borrower, the more they will listen to you, the more patient they will be, and they're basically tagging along for the ride, and they won't shop you.
Yeah, no, that makes sense. Okay, so then that kind of leads into the next question of, is there anybody you would not work with, and like what are kind of the conditions, or what are some of the situations where you're like, no, we're done, we're not going to work with that person?
Say that again.
Who would you not work with in terms of either the borrowers or the lenders? Are there red flags where you go, no, we're done, and we're not going to pursue that anymore?
I mean, obviously, people aren't responsive, right? I mean,
Sure.
that's paramount. That, and then obviously people are not forthright on values. You see appraisals getting pushed all the time. I mean, that's just red flag 101. You know, I would like to work with people like, you know, Liz, who obviously knows the loan. Some of the clients like just don't know. They'll just like, hey, here's the exception form. You figure it out. Go ahead. I'm like, okay. So I mean, come on. You don't know the loan. You don't know what's going on here. Like this is your job. I'll help you out, you know, once in a while, but not consistently. That's not a partner, right? So I think that's something there. But from like a lender perspective, we want to work with people who know the loans, who are, you know, prompt and responsive, and it works both ways. So I think that's fairly important. Obviously, pricing is, you know, key, and then like, you know, credit, like someone who does have a wide box too as well. But people who, from our perspective, we don't want to work with are people who are not responsive and are not, who are liars, I guess, you know, for the most part. And then from if I was a mortgage banker, I wouldn't want to work with a lender who, again, is not responsive and doesn't have the best pricing or like, you know, great products out there. We can all hang out and have a beer, but at the end of the day, this is a business. We got to get a job done.
Yeah.
Yeah, I mean, fraud, number one. I definitely wouldn't work with a borrower if I can catch anything fraudulent. And with my underwriting background, I definitely look for that kind of stuff. And then, you know, there's some difficult borrowers, but I'll pretty much work with anybody. I'm good with those difficult borrowers. As far as lenders go, I will give every lender a try. You know, there's some lenders that go really low on the FICO scores. I'm gonna give every lender a try. But sometimes, like I mentioned prior, it's really hard to get these loans through underwriting, and it's reconditioning back and forth and like pulling teeth trying to get those loans closed. So those lenders, I've definitely blacklisted about 5 lenders that I will not work with again because it's really hard to close loans with them.
I would say on the lender side, you want to work with a set of lenders that I would say that are very, like I said earlier, that are very creative. For example, there will be deals that doesn't debt service. You have to have a lender that has a no ratio program where even if the DSCR ratio is under 1% or 1.75, they will still do it. They might lower the leverage ratio a little bit, but they will still do it. Or you need to work with a lender that is able to, if the person's credit score is less than 660, because most lenders, they won't even touch it if it's under that FICO score. I have access to lenders that will work with I'm actually closing a deal next week where the borrower's FICO is 611, and we're cashing her out 70% of the value.
Nice.
You don't really find that easily.
Who is that lender?
I'll let you know later.
Do you know Accra goes down to 600 on their FICO?
Good, perfect.
Thank you for the promotion.
Thank you.
Appreciate it. Very grateful.
So you need those. So those are the type of lenders that you want to work with. If the borrower is not liquid, you want to work with a borrower that will have an interest reserve at closing. They don't care how liquid they are as long as they collect, you know, like 6 to 9 months payment at closing. So you have to have access to all of it. If my lenders don't have those features, I don't want to waste time. The next thing is You don't want a lender that has tons of overlays. I have submit. We all know in the business that you submit 10 deals to 10 different lenders. There are 10 different underwriting results.
Yeah.
I can submit the same deal to one lender and it only comes back with title, insurance, and appraisal. You submit to another lender, it comes back with 20 different conditions.
Right.
So you got to be careful who you choose. The good thing with being a broker and the side is you have the pick off the litter.
Yeah.
You know.
Comes back to that level of underwriting. Those underwriters behind there. I mean, some of the underwriters just, they put feel-good conditions on those loans just because, you know, me being a former underwriter, we get all of our loans get audited on the back end. So some of those underwriters are scared, you know, that they're going to get in trouble. They just slap conditions on there. I fight conditions often, and I often get them overturned because underwriters shouldn't be putting conditions on there sometimes that, you know, on the loan.
And then that comes back to that relationship part.
Yeah, and
Right.
the only thing that I would add as well, so I mean, loan level, 1,000%, right? Conditions, you know, do they understand the program, right? You're the originator sending it to a lender. Does the lender truly understand the program that they even offer, right? Have they trained their own people correctly? Follow-up and communication, I think, is huge because we all need each other. You know, there are times where we need our sellers to respond and react, and of course, they always expect that of us as well. But the only thing I would add to all of that, outside of the loan level stuff, is the partner itself. So, for example, you know, what has been interesting over the last year or two, couple of years actually, how many smaller lenders have become like, you know, correspondents, right? So they're buying, but then they sell to us, right? So sometimes some of the smaller people that are offering this to originators on a broker basis, you know, that you also have to make sure, are they financially sound? Will they be able to fund your loan? Not just underwrite your loan, but will they be able to fund your loan? You know, are they sound, quite frankly? Do they have the financial strength to take on your pipeline, to make sure that there's money at the table? So it's not just the underwrite, but often you also have to really look at that partner and say, who are they? Where is their money coming from? Are they a direct lender? Are they, you know, just another person in the chain? I think that's important as well.
Yeah, and I mean, basically, look, to piggyback off of Lisa's point, our job is to manage risk, and one of the more difficult conversations is an EPD, early payment default, and going back to some of these lenders. That's really difficult. We want to avoid that, and obviously we want partners who obviously fund and originate sound loans that we can, like, you know, purchase and buy to as well. And I know we haven't talked too much about RTLs, but those require a lot more heavy lift, and that's why sometimes the underwriting is a lot more detailed. We have to underwrite, as you know, like the sponsors, you know, thoroughly and all, and like the delinquencies on those, the upticks have been really drastic. So that's why we have to be a lot more cautious.
There has been an uptick in RTL.
Yeah, it's like basically, yeah, maturity defaults. I mean,
Interesting.
There are a lot. Because, I mean, to what Alwan had said, right, like you do a bridge loan for 12 months. Okay, what's the guy going to do at the end of 12 months? Ask for an extension. That's not,
Yeah.
you know, we're not here to do that, right? There needs to be a disposition.
Yeah, we only get paid when we get paid.
Yeah.
Yeah. All right, let's talk about different products that different lenders offer. What are some different products that are out there, and then how extensive does any one lender need to be? Can you just specify into one thing, or do you need to be the lender that offers to everything?
I love having lots of different lenders. I love coming here to these events and meeting new lenders. I've met quite a few lenders that go down to $75,000 on the minimum loan amount, 3 months cash out refi seasoning. I love getting new lenders because some of the lenders I have don't perform. I don't want to send them loans anymore, so I need to find new lenders. I love having a broad spectrum. UWM has no minimum loan amount on the DSCR loan product. There's lots of lenders. There's actually more lenders than a few that go down to 620, 640 on those credit scores. Yes, it's more challenging to get those loans done because of the borrower's profile and the underwriting behind it with those lenders. Different cash out refi seasoning, as I mentioned. Some lenders, if it's your home was listed on the MLS, lenders have a guideline around that. So in my perspective, I love having a broad spectrum of lenders.
Yes. When you think about the property types and the different food groups, you want to make sure that you have different types of DSCR lenders, because DSCR is not only focused on residential, it's not only focused on 1 to 4 units. Of course, you have DSCR for multifamily, for commercial, for warehouse,
Mixed
stuff
use.
like that. Because especially on the commercial side, a lot of times it works similar to the resident. Well, actually, on the commercial side, it's more. We want to make sure that the property is cash flowing and the property can pay for itself. So I do a lot of DSCR loans on commercial properties where we don't do a universal underwriting per se. We just underwrite the property, not the borrower. On the 1 to 4 unit side, we do both. We underwrite the borrower and the property's cash flow.
Okay.
So you want to make sure that you have different lenders for different property types.
Okay.
Yeah, so in terms of like products, I guess the question was like which ones are a little bit more scarce or a little bit more credit. So right now in the capital markets for non-QM, and people like investors, when I say investors, insurance who basically buy a lot of these loans are the end users or securitizers. They don't like P&L loans because there's like an uptick in delinquency there. I-10 is not preferred either as well. So we've had to scale back and get a little bit more creative, and you will notice that's going to be a trend right within the market as well. So I think that product will probably not be offered as widely, or it's going to scale back in terms credit. So those are two that stick out right now. On the RTL side, people are. I know we're going to get into the whole fires and what's going on, natural disasters a little bit later on, but I mean that's becoming a concern. So I think maybe leverage will probably scale back a little bit, but I think that's just something in the back of our minds. Again, we're just trying to manage risk, and we just don't want to hold bad loans on our balance sheet. So.
Yeah, and you had mentioned securitizations, right? So when your loans are going into a securitization, you have a certain aspect of what that appetite is. My particular company is backed by insurance money rather than, we have the ability to securitize, or we have more of this portfolio style money. So I would say even with that, we're also pretty vanilla. Like what we do is pretty much in the middle. Like our minimum score is 680, and our box is, I would say, smaller than yours at ACRA and others. But we price that very well, and we do it, and we know it, and we do it very well. So for us, it's more like what we know and what we're comfortable with. We price it well, we do it well, and we're successful there. And so people know who we are. So that when you're looking for your lenders and you're understanding that, you've got your person that does more vanilla stuff. They're priced well. They know what they're doing. Okay, you've got that checkbox. And then you've got your broader sense of product. We do non-QM. We do all the bank statement, the P&Ls, and all of those products. On the DSCR side, which is primarily what this is referring to, I would say probably at least 40% of our volume is DSCR right now, and we do quite a bit of exception lending through that process. We're not doing any RTL right now,
Really?
so that would be something that we could look at, but right now for our profile, it's more straight non-QM and the DSCR.
That's interesting.
Yeah, and then so in terms of DSCR, look, the below 1 or below 0.75 ratio, those are not liked by insurance companies out there. More insurance companies are coming in. There's about, I think, only 5 insurance companies buying right now, if I'm not mistaken, in the open market. I know a couple more are trying to also purchase some whole loans too as well. So right now, just think about it. Out of all the insurance, I think there's 300. There's only 5 insurance companies actually buying, residential whole loans right now that are non-QM. So that's.
And Neil, I've been noticing that ACRA has been tightening their underwriting guidelines. What's driving that?
It's basically, again, it's not only ACRA, it's all the other lenders too as well. It's basically, the people who we sell loans to, they just don't, they don't want to see, there's delinquency uptick right now, so that's why we just have to follow suit too as well. Yep.
Okay, so
We are trying to sign up some more money-centered banks too as well, so we're working on that.
So 2 things. So Lisa's not buying RTL loans. I am. Just saying.
Yeah. So I can refer to.
And then on the other hand, there's products that are out there for everything. The one thing that I've had a hard time finding here is an RTL loan for a nonprofit operating in California, and that's been a challenge. So I'm just curious. A bit of a side note, but curious why not lending to nonprofits? I know.
Anybody want to answer that?
I'm not an RTL expert.
Sure. So, I mean, no. So put yourself, like, if you were the lender taking a loan back, you had to foreclose on them.
Sure.
That's, you don't want the negative publicity, right?
So is that really it? It's just PR?
I'm not going to answer for that. Again, we don't do that, but that'd be my
Okay.
initial guess. Or
I mean,
premise.
that kind of makes sense,
Yeah.
right? Because if for any reason anything went bad, you
Yeah.
wouldn't want to.
It looks
hurt
bad.
A nonprofit,
For sure.
Or even be associated with hurting a nonprofit.
The headline risk would not be good.
It's a small nonprofit. We've got a relationship. Come on, man.
Again, it's not me, but you can certainly reach out. There's multiple guys I can refer you to, but we'll talk offline.
Very good. All right. We're talking about bigger or smaller players. So we've got some bigger players here. What about the smaller players? Is there a place for that, or is there an advantage or disadvantage in either going with bigger or smaller lenders out there? Maybe Lisa, that's for you. Or sorry, Liz.
I mean, like I mentioned, I'll give every lender a try. I think for bigger lenders, like UWM, they're the largest wholesale lender. They have great systems in place. Their technology is phenomenal. It's easy to get in touch with an underwriter. The underwriters call you after the loan approval. They call you before they're clear to close. Also, the technology with our clients. They send out an email when your loan is going into underwriting, when it's getting approved. For the larger lenders, that technology piece really does help and comes into play. There's also a bad side to that. There's somebody that does something for everything over there, so and not all the parties talk to each other. And you're also your own closer with UWM. You draw your own docs, so there's good parts to that and there's bad parts. I think the smaller lenders definitely need to up their tech, and could be a little harder to just get some things done with them. But I'll give everybody a try.
I would say the bigger lenders for the bigger loans, obviously, because they can handle the bigger loans. They have bigger warehouse lines and stuff like that. Smaller lenders for the small loans, but just bear in mind that the bigger lenders like I said earlier, the bigger lenders usually comes with more overlays. Smaller lenders, less overlays. So it just depends on the complexity of the deal. I would actually rather bring a more complex deal to a smaller lender than a bigger lender.
That makes sense. They can be a little more flexible tech.
Yeah.
Overall.
The ideal, right, would be somebody, which we strive to be, which would be a larger lender, but one that works directly with you and like is in the trenches with you, right? Like the underwriters are like you described with UWM, you're talking to the underwriter, they're working the deal with you. For us, working with the scenario team, like the scenario team helps people put deals together all the time. So even though we are a larger lender with very strong financial backing, we try and strive to be more of that hands-on, high touch. We do have good technology as well, it's just bringing all those components together, and really working with our sellers just to make sure, like, are we meeting your needs? Like, what else can we be doing? We also try to do things like provide a lot of training, and some of those things take resources. So larger lenders do have a lot more resources in order to be able to deliver, I think, on some of those things, where the smaller guys, might be like literally working hand in hand with you. There's a value there for sure, but there's also a value to somebody who has a lot of resources and really can do a lot for you.
Yeah. All right.
So, yeah, I mean, like, if you go with a smaller person, you are going to get more attention, obviously, but I don't know stability there. We're in a volatile market right now. I mean, everyone on the stage will tell you that, testify to that. Obviously, the larger players, they will most likely be around. I've been wrong in the past, so I don't want to go on a limb and say that, but there's a lot more stability there. If that's important to you, relationship stability, then I would say stick with the larger lender, but obviously talk to a smaller lender. If that's something you want to do for like the more complex deals, absolutely. Just you need to talk with everybody, but Again, if it was me, the larger lenders, stability, they're going to be around. They're usually great on pricing. So obviously the turn times and the service, sometimes we do get the calls and complaints. We're not perfect. We try, but yeah.
So let's go into that volatility just for a second. So let's talk about the fires and things like that. Like, what effect is that having on specifically DSCR lending? And then kind of to piggyback on that, like why are the borrowers looking for DSCR loans versus other kinds of loans? And does volatility play into that?
I want me to start. Okay, so those are two very good questions.
Yeah.
Well, as far as the fires are concerned, I mean, it's just absolutely awful and heartbreaking, and I think we all are thinking about anyone affected there, number one. But, especially for anyone, primary residences, DSCR, investment properties, if you kind of take the emotional piece out of that for a second, it's going to be so challenging. You think about, like, everybody talks about inventory, right? So if you listen to anybody talk about our industry, inventory, rates, inventory, like those are all common themes that we've been talking about. And now you've got whole areas that are decimated. So obviously, how does that impact inventory? How does that impact, where are all these people going? Where, there's no places for them. What are they going to be doing? ADAs I know are very big, and especially in California. So, there may be opportunities for people that have properties that have not been infected, but just the whole aspect of everything that's happened is just devastating.
Yeah.
Not just to the people personally, but just to the industry, to people who want to buy a home, to people that, how long is it going to take to even rebuild? What was that rebuild look like? I don't think any of us can really say today what the impact is going to be. I mean, it's
very interesting.
There's so many aspects to it, so many ways people are impacted by this.
And,
I think that's kind
that
of
and other natural disasters.
Yeah, and I mean, I have a house in Florida,
kinds of
so
things.
it's
Yeah.
hurricanes, it's fires, it's it's insurance. Somebody was talking to me the other day, and I hadn't even thought of this yet. Whereas there are so many people in that area of California that have inherited their homes, right, or lived in those homes, through a couple of generations. And maybe they even had a specific cap on their insurance or their taxes or something like that. Well, all that's gone. I mean, so say maybe I had a cap on my insurance for $2,000 a year. That insurance is probably going to go to $20,000 a year. I mean, they couldn't rebuild if they wanted to. They wouldn't be able to afford to even rebuild in that area. So much. It's overwhelming, and I just think we're all going to be impacted in our industry and everything we do.
So,
what do you think?
Yeah, I live in LA, grew up in LA, went to UCLA, live about 15 miles east of the Eaton fires, and I was in Pasadena on Saturday. Awful. You could just smell the smoke. Even if you're not in the evacuation area, you can't stay there because the smoke was just so bad. Went to go visit a buddy, there, and it's just 15 miles away. The embers were flying. You could just see them. And then at UCLA, just love the school more than anything else. But the Palisades, when we were all going to school, we'd drive around the area. Just blessed to go there. The Palisades is one of those areas where we're all hey, when we do well, we want to live here. And just to see that community just burn down like nothing. And there's people, their homes, nothing happened. But the problem is when a home is demolished two homes away from that, you knew those people, the sense of community is gone. That's what made the Palisades great and is just beyond sad. So that's why I couldn't answer the question. It's just, it's tough. And everyone I've met with yesterday asked how it was. And I just to be really honest with you guys, it sucks. It's really heartbreaking and it sucks. But why people would do we asked, why are you doing a DSCR loan? Why don't you just use bank statements or go full doc? Most of the operators, it's just ease of use, right? The rates, it's fairly competitive. That's the generic answer we get. But yeah, all product aside, conference aside, the emotional tick, what's going to happen, it's going to be tough, and it's going to be hard.
And again, with natural disasters, I mean, take whatever you want out of it, but they're on the rise. And so how does that play into, what's coming up next, and how do you kind of protect yourself, all those kinds of things? Avalon?
Right. So just to backtrack a little bit, why would you choose a DSCR loan
Yeah.
over any other loan? Well, first and foremost, if you have an appraisal and 1007, you're basically 98% there, basically, as long as you have fair to good credit. Right?
Okay.
That is basically it. So basically all you need is the appraisal, you need a market rental analysis, fair to good credit, and a significant down payment. Significant meaning 20% down or even 25 based on your FICO, all right? In terms of what happened in California recently, believe it or not, there is going to be a mass migration to not just Florida, but I would say Florida, Texas, Georgia, in this area. I am also licensed, so I work with the consumer banks as well that needs the licensing. So on the consumer side, we don't call it DSCR loans, but I do no-doc loans for primary homes as well.
Okay.
So I think there's going to be a huge influx of consumers who are going to be migrating to Florida that can't necessarily show income. Probably don't have a job in Florida as yet, so they wouldn't get approved for a regular conventional or FHA loan.
Okay.
And they can show income, or they can show that they have a new job in Florida. However, they have good credit and they have a significant down payment because they're coming from LA with a lot of money, right? So so I think that there's going to be a mass exodus. There's going to be a huge influx of not just DSCR loans, because tons of investors are going to be buying up. I mean, probably, they can also use a house hack where they can purchase the house as a DSCR loan for the first year, purchase it as an investment property, and then convert it to a primary home after the first year. That is a house hack too.
Interesting.
So that is gonna be crazy.
Yeah.
Madness.
They are signing something in their documents, though, saying that they're not going to be occupying the home.
Say it again?
It's going to be a rental property when they're signing the loan docs.
Yeah, no, but usually you can buy it as an investment, but on the loan docs, you state that you're occupying for 1 year, at least 1 year. After the first year, we don't care what you want to do. Right?
I don't know. I can't speak to a lender on that. I don't think they would allow that. I mean,
Depending
DSCR.
on the lender. Every lender is different.
Sure.
Yeah, definitely. I mean, DSCR is easier, no income, no job requirements. I always give my investors a choice. You can go full doc, and we can collect all your income documentation, and it can be based off of your DTI, your debt to income ratio. But they always choose to go DSCR. They don't want to provide all those documents. You know, the rate is not that much higher for a DSCR loan, maybe 0.5 point for good credit borrowers, or less than that. And then when you get into underwriting, there's less hurdles that you have to jump. We're not having to, re-pull the inquiries to see if there's any new debts on there. We're not having to get VOEs. My perspective, I just think DSCR loans are just easier to get done and through underwriting.
Are they generally faster to get through the process?
They can be. I mean, typical turn time is probably 30 days, but I think it's lender dependent of how fast they are, and then your borrower, how fast they can provide the documents, and then how fast you get that appraisal done. And then, any natural disaster, we're going to have to get a 1004D to verify that the property is still standing. So there's always some extra hurdles when disasters are going on.
All right. Let's see. If anyone's got questions, now's the time, but I've got a couple more if nobody else does. Let's see. No questions? All right. We've got where are we here? What kind of, so Liz, you mentioned tech earlier, and some of the bigger players tend to have that more in place. What kind of things are you looking for? Like what helps you as a broker when you're looking for loans?
I mean, my assistant will tell you, having a portal where she can export a 3.4 file from our LOS into theirs is very important. Some of those smaller lenders don't have that ability, and she's having to retype the whole loan application. I mean, it's a time waster. So for smaller lenders, I would say definitely if you can upgrade your tech, exporting that 3.4 file, having ability for me to get into a portal to be able to see what the conditions are. Some of the lenders don't have that. So I can lock the loan in their portal, do a change of circumstance. You know, some lenders take 24 hours just to change a loan amount, being able to relock a loan. So those things are very important to me. And then on the borrower perspective, you know, like I mentioned with UWM, I think it's just a nice plus for them to know when the loan's going into underwriting, when it's approved, when it's clear to close, and they get those emails from UWM.
Okay. Anybody else on that?
DSCRs are very simple loans. Doesn't really need a lot of tech to get the job done. I have a LOS that I use. I'm sure a lot of you are familiar with Arrive. It's very, very simple. I have a loan assistant, but I love to take the apps myself. If I'm too busy, then I let my loan assistant do it. I don't send the app to my clients ever. I take the app over the phone, get it done. Once my MISMO is ready, that's basically it. All I'm waiting on now is the appraisal, the title work, and the insurance. So, but yeah, thank God for Arrive. I don't know if anybody from Arrive is here, but they make my job very, very
But they
easy.
should be.
And I really don't need much because they're simple loans.
And I know there's Lightning Docs was here, that kind of thing. I think that can be very useful.
They're good too.
Yeah, good.
Yeah.
I think those are all the questions I have. Anybody else have anything else they want to add or last words?
Sure. So, I mean, everyone asks when are rates going to come down? It's still volatile right now in the markets. For RTLs, those rates have come down. I think towards the end of the year, you'll see a little bit more of a gradual downward tick in terms of rates. So there's that. And then, yeah, I'm not an expert. Don't know what the 2-year and the 10-year are going to do. But that's something we monitor on a daily basis. That'll pretty much determine pricing moving forward. But we think rates should be better at the end of the year than they are right now.
Yeah, and just on the rate side, I would say that, for the programs that we're talking about today, they're just not as rate sensitive. So everybody here obviously is doing these products, and that's why you're here. One of the things that we try to do, and I'm sure you do as well, is really talk to people about broadening the products that they offer. A lot of people that we've probably dealt with in the past are, and you too, I was listening to your underwriting background, more agency style people. We're just trying to educate loan officers around the country around the products themselves, the advantages of these products. Generally, the products have performed extremely well, much better than an FHA loan, as an example. So, there's opportunity in these products. So if you're not originating them today, you should be. And certainly Liz would be a great person to talk to because it sounds like she's got it all down. I would say that. And then just as one aside around the LA County piece, I would also say that right now, everybody's kind of on hold buying, funding loans, because everybody's unsure what's happening. But one thing we will be sure of in LA County, we're recommending to our sellers right now, is to get PDIs. So get those post-disaster inspections, start to do that now because FEMA will generally give information relative to a county and not zip codes. So more than likely, even though your loan is in the county that may not have been affected, you may still have to get those post-PDIs, post-disaster inspections. So if you can be proactive, that is something we are actually recommending our folks to start to do now.
I love working with investors, and I loved working on the DSCR loan product. I would say if you want to get into space, get out there and network. meet these investors face to face. And, investors want speed. If you're going to take 3 days to get a quote back to them, they're going to go to somebody else. I'm going to get that client from you. So speed, answer your phone, get back to them diligently, accuracy, just because we have a loan in process doesn't mean we're going to get it closed. So using a lender that we know can close these loans. And then communication is just key. So I would highly recommend you get into DSCRs and working with investors because they are loyal to you. If you do a good job, they're going to come back to you and they are going to refer you to their friends. And a lot of these investors have 10, 20, 30, 40 properties. They're going to feed you for a lifetime.
I would say, guys, work, and this is for other brokers and realtors and borrowers. Work with a lender or a broker who is an advisor, not just a broker. Because at the end of the day, it's all about relationships, and make sure that you're working with somebody that can get the job done. In terms of being flexible and have access to different programs to make sure that you can accomplish your goals. That's it. Much.
Great. I think that's it. Thank you so much, everybody. We're done.
Thank you.